Let's go to the next one, which is the medium risk asset class investments. Okay. For the second one, we have mutual funds and SIPs. Here you are diversifying your portfolio. You're not investing in one particular stock, but a large cap or a mid cap or a thematic fund. So you are diversifying your risk, not investing in one company, but a bucket of different companies. So the risk is diversified. So the risk becomes medium and not high. You can invest in a lump sum format. You can invest in an SIP format where you're investing every month. That again diversifies your risk even more because now you're investing in a growing market and a falling market. So you're averaging out the returns because you're averaging out the buying process as well. So SITs become one. NPS, which is National Pension Scheme, sounds like a safe asset class. It is actually investing money in the market, and that is why you see 10-12% average returns on the portfolio. What they show us is what is expected. The returns, when they going to come us, it is going to be split into 60-40. You are going to have taxable returns out of it. If you remember, the characteristic of the medium risk asset classes, returns can be tax free or taxable. Here you get both the quotients in this, so that is NPS for you. Banks and post office deposits. So banks and post office deposits are going to give you returns. The returns will be good for a specific percent timeline because it is connected to the repo rate. So maybe a 5-year deposit decided it is going to be you tax free, but for 3 to 1 year FDs are taxable at different tax slabs according to your tax slabs, right? Plus the returns are fluctuating because the repo rate changes. But it is a medium risk asset class. You can take that risk, figure out what you want as the returns, invest over there. Property and rental units, fluctuation in the property prices. Yes, it is an appreciating asset, but it all depends on where and what location you are in. Sometimes the appreciation is too high, sometimes the appreciation is not too high. On an average, Indian real estate market grows at around 7 to 9%. Places where there is metro cities or something new coming up, there's MIDC area coming up next to you, and that is a road boring next to your land property. Then the appreciation is higher. Otherwise, the appreciation is not too high. The yield from rents, yield is what you pay and what you're going to get as returns in terms of rent. The yield is somewhere around 2.5, 3% max. It is not too high. So that's something that you're going to get there. Again, the returns are taxable. Plus the rental units, if the tenant is not there, your rent will not come for the few months, then it will come again. So non-guaranteed in that fashion. But a good asset class to be in. There is a steady growth over there. You can flip properties after a few years and make more money. And this is one of the medium risk asset classes, which I feel personally. Next one is unit linked insurance plans. So insurance plans were in the same basket also. Here in medium term risk, we have mutual funds and other instruments, and there is something called as a ULIP. That is how it is famous. It is for unit link insurance plans. Here the money is taken like insurance policy. You get insurance against it, but the money is also invested in the market. So instead of getting rate returns which are equivalent to the repo rate or opposite more than the repo rate, here your returns are in medium risk. So you can expect up to 5% more returns than the repo rate. So you earn 9% returns because the repo rate right now is 6.05. I'm quoting these numbers. All these kind of returns are good and expected in a ULIP plan. So these are some instruments which we can consider in medium term, medium risk asset class.